Alright, let's get right into it. You've probably heard the term technical analysis thrown around. It sounds complicated, maybe a little intimidating, like something only Wall Street pros with 10 computer screens can do. But I'm here to tell you it's a lot simpler than it sounds. At its core, technical analysis is just the study of past market data, mainly price and volume, to predict future price movements. Think of it like being a detective for stocks. Instead of digging through a company's financial reports, you're looking for clues and patterns right on the stock chart itself. It's all about watching what investors are doing, not just what a company says it's doing, and making educated guesses from there. The big idea behind this whole thing is that history tends to repeat itself. Human psychology doesn't change all that much over time. People get greedy, and people get scared. These emotions drive buying and selling decisions, and those decisions create patterns on a chart. A technical analyst believes that all the important information about a stock, the good news, the bad news, the big institutional trades, is already reflected in its price. So by studying the price action, you're getting a snapshot of the market's collective opinion. You're not trying to figure out if a company is good or bad in the traditional sense. You're just trying to figure out if its stock price is more likely to go up or down. So, let's break it down even simpler. Imagine you're tracking the price of your favorite iced coffee for a year. You notice that every time it drops to $2.50, a bunch of people rush to buy it and the price goes back up. You also notice that whenever it hits $4, people stop buying and the price falls. You've just done a basic form of technical analysis. You identified patterns in price behavior. That's really all it is. We're just applying that same logic to stocks, cryptocurrencies, or anything else that is traded on a market, but with slightly more sophisticated tools than just watching coffee prices. Don't let the fancy jargon fool you. Terms like Fibonacci retracement or Bollinger Bands can sound scary, but the principles are straightforward. It's about supply and demand visualized on a chart. When demand is higher than supply, the price goes up. When supply is higher than demand, the price goes down. Technical analysis gives you a visual roadmap of this constant battle between buyers and sellers. It's a skill, and like any skill, it takes a little practice. But it's definitely not rocket science, and you absolutely do not need a PhD in finance to understand the basics and start using them to make smarter decisions. So, why would anyone choose to stare at squiggly lines on a screen instead of reading a company's annual report? That's a great question. The main reason traders use technical analysis is for timing. Let's say you've done your research, and you believe a company is fantastic. You think it's going to be the next big thing. That's great, but it doesn't tell you when to buy the stock. You could buy it today, only to watch it drop 20% over the next 3 months before it finally starts to go up. Technical analysis helps you identify potentially good entry and exit points, helping you avoid buying at the top or selling at the bottom. Another huge reason is risk management. This is probably the most important part of investing, and it's something I talk about all the time. Technical analysis gives you a clear framework for managing your risk. By identifying key price levels, which we'll talk about later, you can set a stop loss. A stop loss is an order you place to automatically sell a stock if it falls to a certain price. This is your safety net. It protects you from catastrophic losses. Without a plan, emotions take over. Technical analysis helps you make a plan before you invest, so you're not making panicked decisions when the market gets choppy. It's also incredibly versatile. The same principles of technical analysis can be applied to almost any market in the world. Whether you're looking at stocks like Apple, a cryptocurrency like Bitcoin, a commodity like gold, or even foreign currencies, the tools are the same. The charts may look different, but the underlying psychology of buyers and sellers creates similar patterns everywhere. This means that once you learn the skill, you can analyze a wide range of potential investments without having to become an expert in every single industry. It's a transferable skill that can open up a lot of opportunities for you. Finally, technical analysis provides confirmation. Many investors, including myself, use a mix of both technical and fundamental analysis. Fundamental analysis is when you study the company's health, its earnings, revenue, and debt. Let's say your fundamental research tells you a stock is undervalued. You can then look at the chart. If the chart shows the stock is starting an uptrend and just broke through a key resistance level, that provides confirmation. It's like getting a second opinion that says, yes, now looks like a good time to act. It adds another layer of confidence to your investment decision. When you first open a stock chart, you'll probably see one of a few different types. The most common one, and the one we'll focus on, is the candlestick chart. It might look a little weird at first, but each candle tells you a complete story of what happened to the price over a specific period, whether that's 1 day, 1 hour, or even 1 minute. Each candle has a body and 2 wicks sticking out of the top and bottom. It's way more informative than a simple line chart that just connects the closing prices. It gives you a much richer view of the market action. Let's dissect a candlestick. If the body of the candle is green, it means the price closed higher than it opened for that period. The bottom of the green body is the opening price, and the top of the body is the closing price. If the candle is red, it's the opposite. The price closed lower than it opened. The top of the red body is the opening price, and the bottom is the closing price. It's a simple visual way to see if the buyers, bulls, or the sellers, bears, were in control during that time frame. A lot of green candles in a row suggests strong buying pressure. Now, what about those lines sticking out? The wicks. The wicks, or shadows, show you the highest and lowest prices the stock reached during that period. The very top of the upper wick is the high of the period, and the very bottom of the lower wick is the low. So in one single candle, you get 4 key pieces of information: the open, high, low, and close. This is incredibly useful because it shows you the volatility and the full range of price action, not just where the price started and ended. A long wick, for example, might show that there was a big battle between buyers and sellers. So when you look at a candlestick chart, you're seeing a series of these stories play out over time. A long green candle with a tiny wick shows that buyers were in complete control from open to close. A candle with a small body but very long wicks on both ends shows a lot of indecision in the market. By learning to read these individual candles and the patterns they form together, you can start to get a feel for the market's mood and momentum. It's the very first step in learning the language of the charts, and it's a foundational skill for any technical trader. One of the most fundamental concepts in technical analysis is the trend. You've heard the saying, "The trend is your friend." This just means it's generally easier and more profitable to trade in the direction of the main trend rather than trying to fight against it. Think of it like swimming in a river. You can try to swim upstream, but it's going to be a lot harder and you'll get tired quickly. It's much easier to just go with the flow. In trading, identifying the direction of the main current is your first job as a technical analyst. It's the single most important piece of information you can get from a chart. There are 3 types of trends you need to know. First is the uptrend. This is pretty straightforward. An uptrend is identified by a series of higher highs and higher lows. The price goes up, pulls back a little, then goes up to a new higher price. Each peak is higher than the last peak, and each valley is higher than the last valley. This is a sign of a healthy bullish market where buyers are consistently in control. When you see a clear uptrend, the general strategy is to look for opportunities to buy, especially during those temporary pullbacks or dips. The second type is the downtrend. As you can probably guess, this is the exact opposite of an uptrend. A downtrend is defined by a series of lower highs and lower lows. The price falls, bounces up a bit, and then falls to a new lower price. Each peak is lower than the previous one, and each valley is also lower than the one before it. This is a characteristic of a bearish market where sellers are dominating. In a downtrend, the path of least resistance is down, so traders might look for opportunities to sell or short the stock, or simply stay away and wait for the trend to change. Finally, there's the sideways trend, also known as a range or consolidation. This is when the price isn't really going up or down. It's just bouncing between 2 relatively stable levels, like a ping pong ball. The highs are all at a similar price, and the lows are all at a similar price. This indicates a period of equilibrium where buyers and sellers are evenly matched. And there's a lot of indecision in the market. A sideways trend can be tricky, but it can also signal that a big move is coming. The price is coiling up like a spring, and eventually it will break out, either to the upside or the downside, starting a new trend. Now let's talk about two of the most important concepts in technical analysis: support and resistance. These are the invisible walls I mentioned earlier. Imagine a stock's price is like a ball bouncing in a room. The floor is support, and the ceiling is resistance. Support is a price level where a downtrend can be expected to pause due to a concentration of demand. Basically, it's a price point where a lot of buyers tend to step in and start buying, which prevents the price from falling further. The more times a stock price hits this floor and bounces off it, the stronger that support level is considered to be. Resistance is the opposite of support. It's the ceiling. Resistance is a price level where an uptrend can be expected to pause or reverse due to a concentration of supply. This is a price where sellers tend to emerge, taking profits or opening new short positions. This selling pressure overwhelms the buying pressure and stops the price from moving higher. Just like with support, the more times the price hits this ceiling and gets rejected, the more significant that resistance level becomes. It acts as a cap on the price, at least for a while. So, how do you find these levels on a chart? You just look for them. Look for previous peaks and valleys. A price level where the stock has peaked multiple times in the past is a potential resistance level. A price level where the stock has bottomed out several times is a potential support level. You can draw horizontal lines on your chart to mark these areas. It's not always an exact price, but more of a zone. Think of it as a thick floor or ceiling rather than a thin sheet of glass. The price might poke through it a little bit before bouncing back. The really interesting stuff happens when these levels break. When a stock price breaks above a strong resistance level, it's a very bullish signal. The ceiling has now become the new floor. Old resistance often becomes new support. This breakout suggests that the buyers have finally overpowered the sellers and the stock could be ready to start a new leg up. Conversely, when a stock price breaks below a strong support level, it's a very bearish signal. The floor has been broken. Old support becomes new resistance. This signals that sellers are in firm control, and the price could fall much further. As prices move up and down, they often form recognizable shapes or patterns on the chart. These patterns are created by the collective buying and selling of all market participants, and they can give you clues about where the price might go next. Think of them as formations that repeat over and over again. By learning to spot these patterns, you can get a heads up about a potential trend reversal or continuation. We're not talking about anything super complex here. Let's start with a few of the most common and easy to spot patterns you'll see. One of the most famous reversal patterns is the head and shoulders. This pattern signals that an uptrend may be coming to an end. It looks just like it sounds. There's a first peak, which is the left shoulder, followed by a higher peak. That's the head, and then a third, lower peak, which is the right shoulder. All three peaks bounce off a common support line, which is called the neckline. When the price finally breaks down below that neckline, it's a strong signal that the trend has reversed from up to down. It shows that buyers tried to push the price to new highs but failed, and sellers are now taking control. Another common reversal pattern is the double top or double bottom. A double top looks like the letter M and often appears at the end of an uptrend. The price rises to a peak, pulls back, rises again to a similar peak, but fails to break higher. It shows that the stock tried to break through a resistance level twice and failed both times. When the price then falls below the low point between the two peaks, it confirms the pattern and suggests a further move down. A double bottom is the opposite. It looks like the letter W, appears at the end of a downtrend, and signals a potential reversal to the upside. There are also patterns that suggest a trend is likely to continue. These are called continuation patterns. A common one is the flag or pennant. These patterns occur after a strong, sharp price move. The price will then trade sideways or slightly against the trend for a short period, forming a shape that looks like a small flag or a triangular pennant on a flagpole. This represents a brief pause or consolidation before the original trend resumes. A breakout from this flag pattern in the direction of the prior trend is a signal that the stock is ready to continue its move. The key with chart patterns is not to jump the gun. A pattern isn't confirmed until the price breaks out of it. A head and shoulders pattern isn't complete until the price closes below the neckline. A double top isn't confirmed until the price breaks below the support between the two highs. You need to wait for that confirmation. These patterns are not foolproof, nothing in the market is, but they give you a statistical edge. They help you build a thesis about what might happen next, and just as importantly, where you might be wrong if the pattern fails. Beyond looking at price action and patterns, technical analysts use indicators to get more insight. Indicators are just mathematical calculations based on a stock's price or volume, and they're plotted on the chart to help you make decisions. They can help you confirm a trend, measure momentum, and spot potential reversal points. Don't worry, you don't have to do the math yourself. Your charting software does it all for you. You just need to know what the most common ones are telling you. Let's look at two of the most popular and useful indicators for beginners. First up is the moving average. This is probably the most widely used technical indicator on the planet. A moving average smooths out the price data to create a single flowing line, making it easier to see the underlying trend direction. For example, a 50-day moving average calculates the average closing price of a stock over the last 50 days. As each new day passes, the oldest day's price is dropped and the newest one is added. When the stock price is trading above its moving average, it's generally considered to be in an uptrend. When it's trading below, it's in a downtrend. Traders often use two moving averages at once, a shorter-term one and a longer-term one, like the 50-day and the 200-day moving averages. When the short-term average crosses above the long-term average, it's called a golden cross, which is a very bullish signal. It suggests that momentum is shifting to the upside. When the short-term average crosses below the long-term average, it's a death cross, which is a bearish signal. Moving averages can also act as dynamic support and resistance. In a strong uptrend, you'll often see the price pull back to the moving average and then bounce off it. Another incredibly useful indicator is the Relative Strength Index, or RSI. The RSI is a momentum indicator. It measures the speed and change of price movements on a scale from 0 to 100. It helps you identify when a stock might be overbought or oversold. Generally, a reading above 70 suggests a stock is overbought, meaning it has gone up too far, too fast, and might be due for a pullback. A reading below 30 suggests a stock is oversold, meaning it has gone down too much and might be due for a bounce. This doesn't mean you should immediately sell an overbought stock or buy an oversold one. The RSI is most powerful when it's used to spot divergence. This is when the indicator is doing the opposite of the price. For example, if the stock price is making a new high, but the RSI is making a lower high, this is called bearish divergence. It's a warning sign that the upward momentum is weakening and the trend could be about to reverse. Conversely, if the stock price makes a new low but the RSI makes a higher low, that's bullish divergence. It suggests that the downward momentum is fading and the price might be getting ready to turn up. It's a powerful tool for spotting potential trend changes early. Okay, so we've covered a lot of ground. You know what technical analysis is, why it's useful, and you've learned about charts, trends, patterns, and indicators. Now, how do you actually start using this stuff without risking your hard-earned money? The first step is simple. Just start looking at charts. You don't even need to make a trade. Pick a few stocks you're interested in, maybe companies you know, like Apple or Tesla, and just watch them. Open up a free charting platform like TradingView or the one offered by your broker and start applying what you've learned. Your first practical exercise should be drawing lines. Seriously, find a stock and try to identify the main trend. Is it an uptrend, downtrend, or sideways? Then try to draw horizontal lines for support and resistance. Look for areas where the price has bounced or been rejected multiple times. Add a couple of simple moving averages, like the 50-day and 200-day, and see how the price interacts with them. This process of manually marking up charts is the best way to train your eyes to see the patterns and levels that matter. Do this every day for a few weeks, and you'll be amazed at how much more comfortable you become. Once you feel a bit more confident in your ability to read a chart, the next step is to paper trade. This is simulated trading. You use a platform that lets you make trades with fake money. This is an absolutely crucial step. It allows you to test your strategies and ideas in a real-time market environment without any financial risk. You can practice identifying setups, setting entry points, and, most importantly, placing stop losses to manage your risk. Paper trading lets you make all the beginner mistakes for free. Trust me, you'll make them, and it's much better to learn those lessons with fake money than with real cash. When you're ready to trade with real money, start small. I mean, really small. Your goal at the beginning is not to get rich quick, it's to learn and survive. Risk only an amount of money that you would be completely okay with losing. Your focus should be on following your plan and executing your strategy flawlessly, not on the profit and loss. Keep a trading journal. Write down why you entered a trade, what your plan was, and what the outcome was. This will help you learn from both your wins and your losses and refine your approach over time. This disciplined process is what separates successful traders from gamblers. So there you have it. That's technical analysis in a nutshell. It's not some mystical art form or a get-rich-quick scheme. It is a practical skill set that helps you analyze market psychology, identify trends, manage risk, and improve the timing of your trades. We've gone over the very basics, from reading candlesticks and identifying trends to spotting simple chart patterns and using common indicators like moving averages and the RSI. These tools are the building blocks that thousands of traders around the world use every single day to navigate the financial markets. It's all about putting the odds in your favor. Remember, the goal here is not to predict the future with 100% certainty. Nobody can do that. Anyone who tells you they have a system that never loses is trying to sell you something. The goal of technical analysis is to work with probabilities. It's about creating a structured plan based on what has happened in the past to make a high probability guess about what might happen in the future. More importantly, it gives you a plan for what to do if you're wrong, which is how you protect your capital and stay in the game long enough to be successful. The most important advice I can give you is to be patient and keep learning. This is a journey, not a destination. Don't expect to become a master overnight. Start with the steps we outlined. Observe charts, paper trade, and when you're ready, start with a very small amount of real money. Focus on one or two simple strategies at first. Don't clutter your chart with dozens of indicators. A simple approach with a clear trend, support and resistance levels, and maybe one or two indicators is often more effective than a complex, confusing system. Simplicity is key, especially when you are starting out. Ultimately, technical analysis is a powerful tool to have in your financial toolkit. Whether you become a short-term trader or a long-term investor, understanding the language of the charts will give you a new perspective on the market. It can help you avoid buying into hype at the top and panic selling at the bottom. It encourages discipline, planning, and risk management, which are essential ingredients for success in any kind of investing. So open up a chart, start looking for those patterns, and begin your journey. The best time to start learning was yesterday. The second best time is right now.